Building on our introduction to values-based investing in episode 56, today we welcome special guest Jason Myhre, Director of Advocacy and Managing Partner for Eventide Funds, one of the leading mutual fund families in the rapidly growing faith-based segment of the larger values-based investing movement. Here's a preview.
The problem that we saw with the world of investing is that most investors are outsourcing their investment decision-making to some product, a mutual fund or an exchange-traded fund. They're delegating that responsibility in life to someone else. And the industry in general is guided by essentially a mandate to make profit. And it's gotten pretty disconnected from some sort of a discernment process about where those profits come from. And so what ends up happening is that we end up investing for a return without a lot of insight into how those returns are being generated. And we can unwittingly end up becoming the owners of companies that are at odds with our life because of the decisions of someone else who's making those investment choices on our behalf. And in general, I just think there's this disconnect in the world of finance between returns and the activities of business. And we wanted to bring those two together again.
All that and more right now on the Retirement Lifestyle Show.
Welcome to the Retirement Lifestyle Show. I'm your co-host, Roshan Loungani, here as usual with Erik, Olson, and Adrian Nicholson. Today we have a special guest with us. Jason Myhre is here with us from Eventide, and we're really excited to continue our conversation about socially conscious, faith-based, values-based, and impact investing. And Erik, I'm going to pass it on to you to tell us a little bit about this and introduce Jason.
Well, Jason may want to frame this in a slightly different way than I'm doing it, but we had told you, our audience, when we did a few weeks ago, our first episode in this series on value-based investing, that we would start with this large conversation that once upon a time was known as socially responsible investing, still has maybe morphed a little bit into a conversation about sustainable investing using environmental, social, and governance factors. And we promised that we would come back with another focused or values-focused investment theme, this time on faith-based investing, and then eventually possibly we'll have another episode on impact investing. So this is our delivering on our promise of that second episode around values-based investing, specifically on faith-based, or sometimes, depending on the community, biblically responsible investing. And so, as is true in the first version, I guess you might say, which was again socially responsible or sustainable investing, there's a growing consensus and growing movement of investors, and for that matter, investment companies supporting that movement, who have said, "Hey, we'll shape a portfolio around this the particular set of values that are largely speaking common to the faith-based community, that on one hand are looking to abstain from investing in certain kinds of companies, as was true with the originally socially responsible investing movement, but at the same time not stop with merely abstaining from things, but we also want to make a positive contribution through the allocation of our capital toward things that will make a positive difference in the world in alignment with that set of values." And so we're really pleased today to have you, Jason, with us, because you come from that line and of philosophically from an investment standpoint, and you're with a company that has proven not only their commitment to those values, but also to a fairly strong capability in actually growing capital. And that's been the knock sometimes on the whole question of introducing values into the the investment decision making process, because won't it inevitably lead to a compromise in the returns that are coming to the investor? And I think what your firm has done quite ably is to show that isn't the trade-off that you necessarily have to concern yourself with. So anyway, we're really excited to introduce to you, our listeners, this conversation, or this additional installment on this subject.
Well, Jason, first I want to say thank you. Thank you for joining us today.
Yeah, no, it's really great to be with you to talk about a subject that I love.
Yeah, and tell us about, so with one of the things that stands out, and you guys have registered this, but investing that makes the world rejoice. I love that statement. Can you tell me a little bit about what that means?
Yeah, absolutely. So investing that makes the world rejoice is, I will say, poetic. It is describing an approach to investing where you are investing in things that you believe ultimately are creating blessing and rejoicing in the lives of others. So it's a particular approach to investing that considers not only the return-making potential of a particular investment, but its ability to contribute to the common good, or to human flourishing, or to the betterment of the lives of others. And so you could think about, for example, within the area of healthcare or biotechnology, where human creativity is being channeled to treat or potentially even eradicate some devastating disease. Our participation in that investment could lead to rejoicing in the lives of those that suffer from this particular ailment. So that's the vision, is that all of our investments would be participating in things that we ultimately feel like are genuinely promoting the common good.
I think that's a wonderful way to use capital, right? If you're an investor, you get to help yourself with that growth, and then help society. Your title is Director of Advocacy. Can you tell me that, just being a broad title? Tell me what that means.
Yeah, it's a really vague title.
Well,
Essentially,
I like it, though.
yeah, it's got a nice sound to it, but people are like, what exactly does that entail? Yeah, so what it is I am an advocate for values-based investing. So I'm not only sort of a brand ambassador for Eventide, I am an advocate for the whole space of values-based investing, and just the basic idea that our use of money should follow and express our values. And there shouldn't be this disconnect in life where we kind of have this pocket of our life off to the side that's focused only on the bottom line without regard to what we consider important, our beliefs, our values, our faith in this case, our ethical commitments in this life.
Yeah, that's awesome, Jason. And when you think about investing, sometimes you can really get caught up in the numbers, like you say, performance, the risk aspect of it as well. Where in this case, you're kind of taking more of an inward look, kind of looking at your entire life, your values, your morals, and kind of integrating that a little bit into different types of investments or different aspects in your life. I kind of really like that concept. Can you go into a little bit more how you kind of began, or you took your first steps in this kind of role that you're in?
Sure. So my entry into the industry started actually when I was in graduate school. I was going to school at Harvard University, and I ended up meeting a guy in my dorm who was a Christian believer. I am as well. And so he invited me along to church, and he warned me this was a house church, so it was a very specific kind of small church setting. But I said, hey, I'm game. So I went along with him, and I ended up getting plugged into this small house church, which is where I met the other partners that ultimately would go on to found Eventide. And so I started with just kind of a personal relationship there. And we started to just meet together, a few of us, and to dream up a way to work together that would serve, as we saw it, a need that existed within the church and within the broader world for just meeting some need. And we considered a lot of different business ideas, but looking at our backgrounds, we ultimately ended up converging on the investing space. And the problem that we saw with the world of investing is that most investors are outsourcing their investment decision making to some product, a mutual fund or an exchange traded fund. They're delegating that responsibility in life to someone else. And the industry in general is guided by essentially a mandate to make profit. And it's gotten pretty disconnected from some sort of a discernment process about where those profits come from. And so what ends up happening is that we end up investing for a return without a lot of insight into how those returns are being generated. And we can unwittingly end up becoming the owners of companies that are at odds with our life because of the decisions of someone else who's making those investment choices on our behalf. And in general, I just think there's this disconnect in the world of finance between returns and the activities of business. And we wanted to bring those two together again. You know, maybe I'll just share one thing here. So just to illustrate this disconnect. So I was at a large investing conference a few years back, and I was listening to a famous portfolio manager describe his investing process. And I'll never forget what he said. He said, in describing his process, he said, "I pride myself on not knowing what's in our portfolios." Which, if you think about that for a minute, you know, this is the person who's choosing the companies, and he's saying he considers it a point of pride to not even know the names of the businesses that he's choosing. Now, why is that? It's because he's a numbers guy. Okay. He's a numbers guy, right? He's a quantitative investor, and when he is evaluating a stock for investment, for example, he's wanting to pay attention to the numbers and not be biased. So in his process, he actually removes the names of the business from his view so he can just focus on the numbers. And on the one hand, that's impressive, that level of discipline to his particular process. But on the other hand, I feel like it illustrates the loss of something meaningful in the act of investing, that the world of business is treated instrumentally as only a way to earn a return without any consideration about how that return is being generated. And so if you kind of put together that general philosophy, which I think is pretty widespread within our industry, we as investors don't have a lot of confidence that our lives are being well reflected in the kinds of things that we are participating in our investing.
Well, so Jason, on that note, Roshan referenced earlier investing that the world may rejoice as one of the taglines for the company. And then there's what you've just said leads me into another area or language that the Eventide frequently uses, which is avoid, embrace, and engage. Am I getting that language right?
Yep.
And so can you go into more of what that really means from an investment standpoint?
Sure. I think it's very helpful to think about investing as company ownership. This is a metaphor, but essentially the fundamental idea of investing is that you are supplying capital to support business. In exchange, you receive ownership in that business. This ownership is what gives you the rights to receive any of the potential profits and growth that might come in the future, which is, of course, why we're all investing, right, to get access to that return stream. But there is this company ownership foundational concept to investing. So when we invest, we need to be remembering there's companies on the other end of the line, and I'm profiting from the activities of business. I'm also helping to support and assist those businesses in growing. And so if you start with that just basic ownership perspective, I think it should invite us to just take a moment and say, well, wait a minute. What are the kinds of companies that I'm owning here? How do I feel about this whole situation of owning businesses? And there are really kind of three different ways that you can process that ownership relationship and investing. And we describe them as avoid, embrace, and engage. So the avoid dimension would be to ask questions like, well, what kinds of companies do I not want to own? What are the things that I just can't in good conscience participate in? And this involves a consideration about either the product of a business or how that business is being operated. So some of the negatives there would be things like, the tobacco industry or gaming, or there's a whole host of issues, pornography. From a faith perspective, there's life ethics issues related to abortion and embryonic stem cells. And so you can actually choose to express a desire to avoid participating in industries or particular business practices. And so that's one way you can express intention vis-a-vis this ownership dimension. So that's one, is avoid. Embrace would be to say, okay, well, what kinds of companies do I want to own? What kinds of companies would I be proud of owning? What kinds of companies do I believe are truly serving society and human flourishing? So it's to take a step very much in the positive direction and to say, well, it's not just about sort of avoiding the bad, it's about preferentially seeking out the good. And so you can identify maybe certain kinds of investing themes that you'd be really excited to participate in. And then finally, there's the engaged dimension, which is, hey, the work of values-based investing isn't done at the moment you place capital, because now you're the owner of a company. And so how do we use that power in that responsibility we have of ownership in an ongoing way to help encourage businesses along a path to creating still more value in the world? And there are certain ways, if you're interested, we could get into the engaged dimension. I think the two big ones, though, are that avoid impulse and embrace impulse, to say, are there any things that I don't want to invest in? Are there things that I would like to invest in? That's kind of the basic framework there.
Yeah, that's a very important conversation to have. And as advisors, and now moving forward with this ESG, faith-based investing, it's all kind of a little bit of a new area. But it looks like investors are wanting to have these conversations more. They are wanting to see how their capital can also be reflected on the values that they have in life. So it's really important. And as advisors, it's important to just have that conversation, or, you want to know your clients as much as possible, and where you draw the line could be very important for them when it comes to kind of constructing a portfolio. So going off that, Jason, how do you kind of see your kind of industry evolving over time? Where are there going to be more investors wanting to have these conversations, looking at these different areas, and how is this going to kind of shape over time? What do you kind of see?
Yeah, I would say that one of the big picture themes that we're seeing is that more and more consumers are becoming interested in how the things that they buy are being produced. And I think we see this outside the world of investing. I think this explains, for example, the broader interest in things like organic foods or restaurants that participate in a local economy. As consumers, we're interested in not just, in the case of food, a delicious meal, but also, how was the food raised, and how are the animals being treated, or how are the crops being raised? And so there's this attention to the behind the scenes. And I think that we've basically gotten along in the globalized economy to a place to now where we're saying we want to bring this back together a little bit, where we want to feel a bit more attached to the means of production and the producers, and how the things that we consume are being constructed. And I think that same basic impulse is what is kind of now coming into the world of investing, where for the longest time it's just been about your quarterly account statement, and were you up a certain percentage or were you down a certain percentage. I think that people still, of course, care about that. They're trying to grow their money over time, but they're increasingly wanting to grow their money in ways that reflect their life. And I think that in general, it's very difficult in this kind of globalized economy to be a person of integrity where what you hold dear is being lived out in every facet of your life. And so we're trying to kind of pull the pieces back together. And I think that same basic idea is what is behind the broader interest in the values-based investing space.
Yeah, Jason, I like how you earlier had talked about people using their dollars wisely, right? I kind of was comparing it to people voting with their dollars, which is a conversation that we've had here before. Erik mentioned earlier about performance, right? So from an investment perspective, as both of you touched on a little bit, people look at performance first. If I'm an investor and I'm looking into this space, do I need to give up performance in order to follow what I believe from a values perspective is a good investment opportunity?
Yeah, I think that a lot of people are concerned about that. And the way that I think it works in the mind of most investors is they imagine this kind of spectrum where it's a spectrum from investing to philanthropy. And so if you think about it, investing is about getting the return without much consideration as to its impact on society. On the other end of the spectrum, it's all about the impact on society with no expectation of return. And so if you had those as kind of the ends of either end of a spectrum, they kind of situate values-based investing somewhere in between, where you're saying, okay, well, I'm doing some social good while getting some form of return. And so I'm somewhere in the middle, which means I'm not at that sort of high performance end of the spectrum. And so we tend to see this as a bit of a seesaw relationship where, just to use another metaphor, where, hey, if we want to shoot the lights out on return, we might need to accept some ethical compromises. And alternatively, if we want to invest in such a manner that would benefit people, we're going to have to accept a lower rate of return. I think that trade-off mentality is pretty common. And I do believe that does describe a certain kind of investing, particularly if you're dealing with a space defined as social impact investing. I think there are certain kinds of investments there. Many of them tend to be private companies where it's all about kind of accomplishing some sort of a social good. And you do, I think, end up taking a concessionary or lower rate of return. But within the world of the public markets, I actually believe it's possible to be as focused on generating return as you are on benefiting the world. And I sort of situate this in this way. So it's really about trying to identify businesses that are poised to grow as a result of the value that they're creating in the lives of others. So I mentioned earlier the healthcare example. Generating a new therapy that addresses a disease may be rewarded in the market financially, but the reason that it's being rewarded is because there's a patient population that is in need of that therapy that experiences the blessing of that therapy. And so you can see there how there can be this win-win relationship where returns are non-competitive with the social impact side of business. And in general, if you operate with that mindset of looking for returns that flow from meeting needs, I think that intersection there can present opportunities to aim at both returns as well as impact.
And do you ever find that, I remember not too long ago, I've seen stories on certain companies that I had thought were socially responsible or for betterment of society, and then something new comes out that I'd never seen before that makes me question, and it's not definitive, so it's not like, hey, they were, but now they aren't, but it's, do you really think you're right and they're socially responsible? Have you guys come across those conflicts before?
Yeah, absolutely. I mean, you do your best on the diligence side of things to try to ascertain the nature and character of a business. And some things are a bit more objective, like the product or service of a business. You can know definitely what they're generating revenue from, and you can consider whether those products and services are good for society. So some of those things I think are pretty forthright and obvious there. What gets harder is when you get into the whole network of relationships within a business. So, for example, how they treat customers, or how they treat employees, or how they treat suppliers, or how they engage in their local communities, or their stewardship of the environment. Those kinds of things are difficult to diligence when you're evaluating a business, and you can miss things. There can be things that you didn't see the first time that you evaluated a business, or the nature of that business could change, with new management, a different philosophy, a different ethos within the company, and this can cause you to gain a new perspective on the company where you say, you know what, I don't think this is as reflective of my values as I initially thought. And then there's a decision point about what to do about it. Do I dump it? Do I sell it? Or do I rather try to engage the company in a conversation around what's going on and the trajectory of the business there?
And you mentioned that as part of your philosophy too, the engagement. What are some examples of what you do from the engagement side?
Yeah. I think this would be a helpful illustration that ties into your prior question. So engage, as I mentioned before, is how do you use this ownership, this ongoing ownership that you have now as an investor, and steward that in a way that helps make the business even better from a values perspective and potentially even from a sustainable success perspective. And let me give you an illustration of an example. So we had invested in a large retailer. I won't mention any names of companies on here, but a large retail business. And as many people know, large retailers will offer a branded credit card. So it's an in-store credit card that you can apply for that enables you to acquire different rewards, which can be used to purchase items at a discount, these kinds of things. And as we were examining the customer financing arm in the business, which was after the point of investment sometime, we started looking at this branded credit card, and the problem was that the interest rates, the effective annual percentage rate on the credit card was high. So high, in fact, that it began a process of doing some soul searching and some contemplation about how high is too high, and what is a fair and just interest rate to charge consumers making purchases on credit. And while we would agree that the use of credit can be a way for people to purchase needful items, I think we also recognize that it can be something like a trap that we can fall into, where in the case where the interest rates are really high, the walls of that pit that we fall into are very slippery and hard to get out of because of the compounding nature of high interest rates. So as we did this soul searching, we ultimately came to the conclusion that indeed this credit card was in the realm of something like that trap or that pit that I described, predatory in nature. And so what do? Do you decide that the company no longer meets your ideals and it's time to sell? Well, we decided this was actually a perfect opportunity to engage the company. And our engagement with the company was not with a posture of kind of this pious activist investor, hurling shame at the company for the egregious things that they're doing, but rather we were investors, and we hoped to continue being investors if we could gain comfort level with what the business is doing here. So we approached with that posture, and because of the way in which we approached them, we gained a listening ear, and we began a series of conversations with the business, trying to persuade them of our point. And ultimately, they did become persuaded. And this resulted in the company terminating the relationship with that particular third-party credit vendor and opening a new credit card vendor for their in-store branded credit card, whose interest rates were well within that range that we had identified as being a fair and ethical interest rate to charge consumers. And both we and the business felt like that was a positive outcome, that we had addressed an ethical concern there, but also the business felt like it had enhanced its value proposition to customers using financing at the business. And so I think this is both an illustration of how opinions evolve as you're an investor over time, as businesses change or as new information comes forward, as well as the value of engaging. And I think finally, just how a values perspective can actually, I think, make a business more robust and sustainable over a long-term perspective.
So, Jason, since Roshan was following up on the engage part, I want to come back to the embrace part, which is the looking for companies that are doing really some powerful good. And just looking through some of the literature, I noticed some of the industry sectors that seem to be ready and waiting for investment of that sort included some things like healthcare, life sciences, cybersecurity, and the list is reasonably long, but it's not it is very targeted, I would say. It looks like maybe 15 or 20 industries, which I thought was fascinating. I also think I heard in one of the presentations, either you or someone else had spoken at from Eventide, that in some cases that means that you take positions in companies that have not yet gone public. And that, to me, I thought, well, first of all, that's really exciting, because I oftentimes think of investing in secondary markets. For the benefit of our listeners, when a secondary market is where the company's already issued the stock, it's out there now and it's in other people's hands. And so when you're buying the stock, you're not sending money, it's not effectively sending money to the company to go do something with. Instead, it's sending money to the person who had the foresight to buy that stock before you did, and or the misfortune to buy it before you did if it went down while they owned it, I guess you could say. But in any case, if you as a fund company are investing in these companies before they've gone public, then indeed investor dollars that are transferred into a mutual fund or other investment product with Eventide then are indeed going and funding that company and making a material difference to their ability to accomplish their mission. And maybe it's the thing that gets them across the line, so that they can actually bring that innovation or that breakthrough to the benefit of people. So I'm interested in that, because I don't think I've ever heard, and which doesn't mean it doesn't happen, but I've never really heard other fund companies talking about doing pre-IPO investing of that nature. Maybe it's more common than I just haven't been paying attention. But it also seems to me that at one level, while it produces a potential for real impact, from an investment standpoint and from an investment company standpoint, it presents a certain kind of risk. Because if they're not liquid and something goes awry, now you don't really have a very clear path to extract yourself from that decision if you come to say, okay, well, that bet didn't work. So can you talk about that?
Yeah. So the structure of, so we have mutual funds as the particular kind of investment product that our asset management company is involved with. And mutual funds in general are purchasing stocks and bonds that are traded in the secondary market, as you said, on the stock exchanges. And that's, for the most part, what most mutual funds, for example, are investing in. But there actually is an allowance for a mutual fund to invest up to 15% of the fund in what are called illiquid securities. So you mentioned the liquidity. A private investment that doesn't necessarily have a market existing to purchase those shares or to sell those shares to someone else. There's no secondary market there facilitating that transaction. Nevertheless, mutual funds have this ability, and we, in some of our funds, take advantage of this ability. Now, there are very strict rules as to that 15%. So a fund cannot exceed that 15%. Under any circumstances. So if a company appreciates in value very rapidly and you eclipse 15%, well, you've broken an industry rule there. And similarly, if the fund experiences a mass exodus of their investors and the assets fall such that 15% becomes, all of a sudden it grows in size, you're in trouble there too. So we actually invest quite a bit below that 15% allowance. We try to stay more in at a maximum of about 7 to 8% on the very high end. But this is something we try to do. And we do it mainly in the area of healthcare. So a few of our investors, including our chief investment officer, come from a background of being in healthcare, biotech, and pharma, including on the private investing side. And so there's some experience there as to how that sort of private investing works within the healthcare space. And so most of these investments tend to be healthcare investments. But to go to your point, yeah, the real exciting thing about participating in a private business is that your capital when you're investing, it actually goes directly into the balance sheet of the company and infuses capital into that business to actually help the company accomplish its purposes. And in the secondary market, as you said, you're buying shares from another investor who owned it before you. And I would be interested to just put a little note here, if we wanted to pick it up later, that I do think the secondary market does shape businesses and the world around us. So we could talk about that if there's interest. But certainly it is the case within the world of private companies. And so just to give you an example here of what this is like. So we do a lot of investing, as I said, in the healthcare biotech space within these private investments. And oftentimes you're actually funding a clinical trial that the company is running on some new therapy that they've developed. And so it's really, really exciting to see when the clinical trial results are posted. If they successfully met their clinical endpoint, the thing that they were hoping to achieve with the efficacy of a drug in a patient population, you can actually look at that chart and say, man, I helped make that clinical trial possible. And so you can see a direct relationship between the way in which you're investing and its potential benefits in the lives of others. And I think that kind of exchange is really exciting, right? Because you're actually in a very meaningful way affecting the world and shaping the world. So it is something we really like to do to the extent that we can within the rules and allowances that we have there. And we do think that it differentiates us a bit from our competitors, although to your question, there are a number of other mutual funds that avail themselves of that 15% allowance as well.
Okay.
It is I would say it is very uncommon, but we are not certainly the only ones doing that out there in the world.
So, Jason, I just wanted you to expand to what you said earlier about how you think secondary markets shape business as well.
Yeah. I really am passionate about this because, Erik, to just put an analogy on what you said about secondary market investing, the analogy that people will often give is that, hey, when you're investing in the secondary market, you're just buying existing shares from other investors. It's not helping the company. And the analogy that they give is it's like buying a used car. So if you buy a used car, your money doesn't go to Honda or Toyota. Your money goes to the person who owned that car. And you're not helping the company one way or the other. So, I kind of hear your social impact point, but I don't buy it, right? Because in the secondary market, just almost by definition, like we're not doing anything with respect to that business. I would offer just a few comments. So I think our investments in the secondary market do, in fact, make a difference. One of them is direct. So this is not widely known, but when you purchase shares of a company in the open market from just some random investor on Wall Street, you're actually affecting the market price for that security. So if you buy something, the price inevitably goes up. And if there are no buyers, the prices inevitably go down if more people are selling. And this market share price is actually in the calculation for a company, what's called their cost of equity or their cost of debt, their cost of capital. And what this is actually the ability of that company to raise additional financing in the future. So when you purchase the shares of a company, you're affecting that company's ability to gain new flows of capital in the future. And this is something that all financiers are looking at. In fact, we had the recent GameStop example where the share price increased quite dramatically, enabling the company to raise more capital. And the reason for that is because of this cost of capital relationship in the secondary market. So that's sort of one. Two, the management teams at companies are exquisitely sensitive to share price. So when we invest in the secondary market, it's essentially a stamp of approval on what they're doing, saying, great job, guys, keep doing it. If we choose not to invest, they begin to have to ask questions about why that's happening or why their competitors are surpassing them in terms of market share price. So this can tweak the psychology of the leaders of a company. Thirdly, I would say that the secondary market, or the primary market rather, depends on the secondary market for its survival. So if you go back in history to the 1600s, to the first stocks and bonds, the first publicly traded companies, one of the first things they realized is that they had to create a secondary market because no one was going to buy these shares unless there was someone else to sell to later. And so we got the first stock exchange in Amsterdam, where people could then trade the initial stocks and bonds from companies like the British India Company to others. And so in some ways, the secondary market is hugely important because without it, the primary market would dry up and cease to exist. There wouldn't be the appetite to invest since most of us are looking to sell later. So that's another one. But then the two biggest ones that I would say are the engagement piece that I talked about. When you're an investor in a company, you actually have a voice and a power within that company to shape the company. And if we use that engagement power, I think that it can accomplish really great things. In fact, I know earlier on your podcast, you had someone speaking about how this was done in the apartheid example with South Africa and racial discrimination and how engagements actually catalyzed the change there. And then finally, what I would say is we tend to view our investments as rather small. So we'll say like, oh man, my tiny IRA or my tiny 401k, and what difference is it going to make if I invested in one company or the other? And what we miss in that perspective is all of the other investors with their tiny IRAs and tiny 401ks. So when you step into, let's say, a mutual fund, you're not the only investor, right? You're joining potentially hundreds of thousands of other investors who are pooling their capital together in a concerted effort in investing it in a business. And so even at my own company, we're about $7.5 billion roughly as of this recording date. We're often a top 10 shareholder in our companies, and our flows of capital change things in the market, and I think in general signal to the market the demand and desire for a certain kind of business to exist in the marketplace. And so while everything you said is true about the secondary market, just from a technical perspective, not putting money into the balance sheet, there's this constellation of other forces that I think in totality actually add up to quite a tremendous force in the world in terms of how the world changes around us.
So another aspect of this that I'm interested in is from the vantage point of the portfolio manager and how two things. Number one, coming back to the pre-IPO investment and the illiquidity of those. What, if any, how do you hedge some of the illiquidity risk in that or maybe you don't need to, maybe having it limited to 7 or 8% is enough of a hedge right there, and that might be a perfectly good strategy. But the other part of me the part of my question is, does the portfolio manager say, when you introduce a values criteria into it, does it alter the stickiness of that investment within the portfolio? Does the portfolio manager think, we believe in what this company is trying to accomplish, even though they're going through a rough patch on revenue, or maybe they had what was expected to be a really killer app or a blockbuster breakthrough on healthcare technology or science or a drug or something of that kind, and then it didn't work. What's our thought process about staying with that, and how does their thought process around that differ from, let's say, their manager across the city who's not taking those values into consideration?
Yeah, no, that's a good question. There was a kind of a few pieces there, so I'll try to remember exactly what all was there. So maybe I'll start with the last part of your question, which was around what happens if you're investing for, as you said, maybe there's an app or a particular treatment that you're hoping for an FDA approval, and it doesn't happen. It goes the other way against you. As a values-based investor, do you sort of hang in there and hope for a turnaround and a brighter future? I think, at least I can only speak, obviously, for our own firm, but I would imagine this is a pretty common view across values-based firms. You still have an investment thesis there that will depend on the success of certain product lines, things like this. So in the case of healthcare, if your thesis is that it'll get an FDA approval and that does not happen, oftentimes the thesis breaks and you say, you know what, that's what we were looking to see, that's what we were waiting for, we now know the outcome, and you exit the position. So we still do have an investment thesis there that's tied to specific outcomes within that business that drives decision-making process. So that's kind of a specific case, but just the general philosophy that you alluded to is that I do think that it tends to instill within the mind of an investor a much more long-term perspective. Because if you're buying a business rather than just a ticker symbol or a potentially return spouting data point, if we have a connection of a business behind the charts, I think in general it can make us a more long-term in our perspective, where we view investing as something more durable than entering and exiting positions to achieve merely a profit outcome. And rather it's much more this long-term partnership with businesses to hopefully grow with them over time. And so I do think philosophically there is much more of a long-termism, which in general I think the market could use a lot more of that, especially in this world where investing is increasingly transactional and algorithmic, where you can get these high-frequency trades that are trying to take advantage of little arbitrage opportunities to eke out a few basis points of return. We actually think that investing should be something much more like a long-term partnership, at least philosophically, and so that's certainly how we lean. I don't know if I answered all the questions.
Well,
yeah.
No, that's fine. That's fine. I guess the one thing that seems as a silver lining in that, which I don't know, that's actually the wrong way to frame it, because silver lining implies that there was something bad about what you just said. There was nothing bad about what you just said, but an additional benefit, let's put it that way, is that in a taxable account, if you have lower turnover, then that's advantageous to the investor in your mutual fund who's doing so in a taxable account.
Yeah, that's certainly one of the factors that is kind of a sort of a hidden cost in investing. If there's a very high churn rate within the portfolio, all of those trading costs that the fund incurs ultimately end up being shared by the investors in the fund. And so, I do agree with that principle that lower turnover, at least with that piece of the total cost of an investment, would be lower with a long-term perspective.
Yeah, those are some really great points, Jason. And it's just really interesting to think about some of the concepts and themes that you really brought up today. And I think our listeners are really going to enjoy it, because if you think about it, when you make that transition from maybe your career into retirement or working less, when you're in your career, it's hard for you to sometimes focus on your investments aligning with your values. Are your morals and your faiths being constantly reflected in your career and your everyday life? And now when you take that kind of transition out of your career field, you have more time to think about it. You have time more to reflect on it and seek out these opportunities or ways that your dollars and your assets can kind of maybe reflect those important meanings in your life and in your values. I think it's a really strong point, and like I mentioned earlier, it seems like that's a conversation people want to have more every day, to kind of look at the long-term aspects, how they're impacting society, how their values are being reflected, so they can really show their character. I think it's a really great theme, and it's something that I feel like I'm just going to have more conversations with people every day with.
Yeah, and I will put a plug in for the value of a financial advisor here. So certainly any of us could, if we wanted to, go and purchase a stock online. We could do our own research, find one that we feel like reflects our values. A lot of us don't have the time for that or the interest in doing that. We feel as though we don't have the skills to do that. And so what happens is we end up outsourcing that decision to someone else, either to an investment product or to a financial advisor who then has their own investment approach using either products or some in-house management. But that fundamental decision to delegate responsibility is where I think a lot of the problems come in, because we end up delegating that responsibility to someone who's not sharing our values and who's not looking for the kinds of businesses that we would look for if we did that ourselves. And so I think that this is kind of what I call the high calling of financial advice. I think financial advisors should view their work not merely as stewarding financial capital, but really stewarding the values of their clients in the decisions that they're making on their behalf. And it can be I think it can be a tremendous value add if the advisor is saying, we're going to try to help you reach your financial goals, but we're going to try to do that in ways that accord with what you consider important, because we know you're working, we know you're busy, and that we want to help fulfill your desire there to live out your values and your use of finances. And so I would just say that as an encouragement to you guys as you meet with clients. I do believe that there is a very high call for the financial advisor stewarding not just wealth, but values and beliefs, wholeness, integrity, and a story of what is going on in the world around us in terms of how our investments shape the business world and indeed the world at large. So take that as an encouragement.
Thank you for that.
Thank you very much.
Listeners, we did not put Jason up to that at all. So that was very kind of you to do that.
Yeah.
So Jason, I have a question about performance, and but also Roshan or Adrian, if you've just got a burning question that you want to pose right now, jump in, and I'll come back to mine.
No, please go ahead.
Okay, so Jason, I think I probably took this from a presentation you did when we did our sustainable investing episode a few weeks back. I was trying to put I was trying to recall. Roshan was able to cite a study that was a 14-year study, and I was thinking that you had talked about a study that was a 20-year study that was looking at. I think if I recall the framework, it was scenario A is take all X number of stocks, maybe it was the S&P 500, and then in scenario B apply this hyperactive value screen where you just think of everything in the kitchen sink is used to screen out companies, and it took out almost half of the companies of the S&P 500. I think you're down to 270, and then looked at the performance of those two sets, the full 500 versus the 270, and it was stunning how down to the hundredth of a decimal point over that their compounded returns were essentially identical. Am I recalling that correctly?
Yeah, no, you're pretty close. So I'll just review it. So basically, my way to address the performance concern of values-based investing is actually with respect to each of those dimensions I mentioned earlier, which is avoid, embrace, and engage. I think it's helpful to just kind of break the performance question apart and consider each of those in isolation. And I think the one that concerns people is if I'm avoiding companies on the basis of ethics, I got a smaller universe of companies that I can buy, and that's going to make it more difficult to generate performance because I might be eliminating a profitable company. And so that's the avoid concern. And so the way to test this is actually say, okay, well, let's think about a real situation. So let's say that you wanted to invest in the S&P 500, but you're a very sensitive conscience, and you actually enumerate 70 areas of ethical concern. So, things like, tobacco, gambling, predatory lending, weaponry, environmental harm, embryonic stem cells, all this, you just throw everything at it, right? So let's say that you did that S&P 500 minus involvement in 70 areas of ethical concern. What would be the result? Well, someone actually did a back-tested result on this, doing that very problem. And it's a 20-year study, and coincidentally, as you said, it got the exact same annualized result as the S&P 500 that is unscreened down to the second decimal place. Now, that was coincidental. If you looked at the chart, you might be able to say, okay, well, in this slice of time, I like the S&P 500 more than I like the screened S&P 500. But then in this other slice of time, I like the screened one better because they would slightly gain on one another and then fall behind. But in general, I think over a long time horizon, the effect of exclusionary screening is rather de minimis. I would not say that it's going to help you in terms of a performance result, but neither would I say is going to harm you. I think that the effect can be accounted for, and that it's rather negligible. And as you said, it actually ended up eliminating quite a few companies from the S&P 500. It ebbed and flowed over time as the values criteria was being applied to that moment in history. But at a high water mark, it eliminated 273 of the 500 companies, eliminated them. So you're over half the index was gone. And yet, even with that level of values screening, you were still achieving the same basic result. And so I just share that as a way to say, it may seem philosophically impossible to apply your values and still pursue your financial goals, but I absolutely believe that it's possible.
Okay, so we're not here to boost Eventide. This
Right.
is, you're gracious to come as from Eventide, but there's no denying that Eventide has had some pretty unbelievably strong returns in some of its funds over the last decade, over the last 5 years, et cetera, et cetera. And so, first of all, kudos to your investment teams for what they've been accomplishing there. And secondly, I guess the question that I would say is insofar as I identified earlier, a lot of it is concentrated in the tech and biotech spaces. I would imagine that similarly, the returns of those kinds of investments are going to ebb and flow with the fortunes of those sectors. And I suspect that just as we've had a pretty strong run for healthcare, we're talking decades long run. That's not probably that edge is probably not going to just disappear overnight. And similarly with technology and so forth. But from a fund family standpoint, do you what do you have conversations internally that say, okay, how much of these really outsized returns are attributable to our specific investment selections, and how much of them are attributable more to the good favor that these sectors have enjoyed? And to the extent that it's the latter, what plans or sort of approaches as a fund family can you take to mitigate some of the periods where those are out of favor somewhat?
Yeah. I like this question because I think it gets to a way of viewing investing. So what we try to do is identify what are called themes, basically areas of the market that we believe are going to grow over long periods of time as a result of just different forces in the world coming together. And these are in the industry, these are called secular growth themes. So that word secular not meaning non-religious, but just attractive, durable, long-term, powerful trends. Mm-hmm. And so, for example, just to give the listeners a mental hold on this, the trend toward the trend away from, let's say, shopping in brick and mortar stores to shopping online. There's a host of businesses that are participating in that, what I think is a long-term trend that we're seeing there. Or to give another example, the trend of businesses who manage all of their IT inside of their building versus those that are outsourcing IT to the cloud. I think this is a long-term trend, and it would be hard to imagine that is going to reverse, where all of a sudden, people are buying these big racks of servers in their offices and these kinds of things. This is important in investing because there's a famous quote from Wayne Gretzky, the hockey player, the Michael Jordan of hockey, and he says, you don't want to skate to where the puck is, you want to skate to where the puck is going. And in general, investing is being right before something happens. And so you always have to be forward-looking and to try to discern these themes that are going to be growing over the long haul. And so we are very thematic in our focus, trying to identify where are the spaces that we think are going to be growing over a long time. And there's a lot of good evidence to suggest that if you can get the spaces right, you don't necessarily have to be a good stock picker. You can kind of pick a bad company in a good theme and do better than somebody who's picking the best company in the wrong theme. And so getting those themes right is really important. And so that in general shapes our investment allocation. I think we do have some in-house domain knowledge of particular spaces, technology or healthcare. So we like those spaces and feel like we can invest within them just from a knowledge perspective. But really the allocation is being driven more by that big picture thematic landscape of where we feel the world is headed. And so, for example, with healthcare, there's a person covering healthcare that we like, Matthew Herpner, and he says that he believes this is biology's century. He's speaking in that thematic language that he thinks for the whole 21st century that the biological sciences and the businesses that make use of those insights are going to be the ones that have that wind at their back, that are in a growing space over time. So that's really, really important to us and why we're in the particular areas that we're in. And so just to maybe attach a values point to this, so we're definitely thinking in terms of those themes, but what we're also doing is saying, what are those spaces that are growing as a result of the value that they're contributing to humanity? And so we call those themes of human flourishing. So we're trying to bring together secular growth themes, which would be more of a pure growth performance perspective, with what we call themes of human flourishing, themes that are attractive because of the way they're benefiting the world. And in general, there is some intersection there. They're not a perfect overlap, and neither are they mutually exclusive. And so we're trying to invest right there to say, we want to be in spaces that are poised to grow because of the value they're bringing to the world. Those big long-running themes. I mean, in general, I would say healthcare is the one that we are most sanguine about. I think, in terms of a thematic perspective, for a very long period of time. I mean, I think it's a 50-plus year, favorable opinion that we have about that space, just because of all the scientific understanding that's feeding into the pipeline for drug development. It wasn't that long ago that we actually sequenced the human genome for the first time. And so now we're understanding today very much the genetic basis for disease, which allows us to develop therapies targeted at a root cause level rather than just, as medicine has traditionally been practiced, kind of treating symptoms in a kind of whack-a-mole perspective. And so that's a space that we probably have our strongest viewpoint on. But in general, I think there are a lot of areas within technology that we feel like are going to continue to grow over time, and so that's why we have a big allocation there. There are so many spaces within IT, and you mentioned earlier, I think Erik, cybersecurity, for example. Just as more and more of these businesses are moving into an online cloud space, and as there are so many new devices that are accessing, businesses from one angle or another, from a phone, from a tablet, from a laptop, you name it, or as devices like our refrigerators and our dishwashers are wired to the internet, this presents all kinds of new vulnerabilities for a business, right? Threats to attack. And there's actually some really interesting stories about this, where there was a news report that came out that actually a casino had been hacked and money stolen from the casino because of someone hacking it through a Wi-Fi device on a fish tank. Just a built-in Internet of Things kind of device. And so, or to give you a contemporary, maybe more popular example here, when Joe Biden entered the White House, he had a Peloton exercise bike, which is wired to the internet. And so they had this whole huge IT crew saying, can national intelligence be accessed through Joe Biden's exercise bike? And so there's, in general, things are not getting better with respect to business security. They're getting much, much worse. And this has produced a big industry and need for excellence within the cybersecurity realm. I'm just giving you one example here, but it's to basically see like what is changing in our world around us, and what do we think is going to be long term. And in the case of, as I said, cybersecurity, it used to be, hey, if you got Norton antivirus on your computer and you periodically keep your definitions up to date, you're good. Those were the good old days, and now it is so complex, and you get these, all of these exotic things that many people have never even heard of, as the way that businesses are being accessed and data being exposed, and so there's a sense in which cybersecurity is no longer compliance, it's defense. And so there are many of these spaces that I think within the IT world, either created by new technologies or because of the risks that are proposed by new technologies that businesses are seeking to address.
And Jason, I'm curious, with these like new technological advances, with even in healthcare and all these new advancements coming out like every day, it seems like in the 21st century, do you find it hard sometimes, or kind of, for the example you used with like the credit card company where you, or the retail business using the credit cards, you said you did some soul searching, some discussions with your team members. Do you find that harder now, or just there's a lot more discussions or debates that come up with these new like advancements coming up, and using your principles and your philosophies that developed over time to kind of implement that to make your decisions?
Yeah, it's a good question. And I would say in general that if one is serious about making investment decisions that are rooted in values, it does require a lot of work. And I'm not necessarily saying on the part of the investor, but I'm saying on those that are actually choosing companies. And the way that I talk about this is, let's say you just have this basic idea of good companies and bad companies. As soon as you start trying to list out what those things are, I think what you end up with is like you end up with some pretty egregious businesses on the negative end of the spectrum, the tobacco industry or whatever. And so you got maybe you get 10 things on the negative side, and then on the other end of the spectrum with the good businesses, you're like, life-saving, new therapies and this kind of thing. And you can come up with a few really high impact themes. But there's this broad space in the middle, right? I would say that in general, the egregious things and the high impact things account for, at least in terms of what we could come up with on paper relatively easily, that's like maybe 10% of the market. What do you do with the other 90% if you're a values investor? And I think this is where you have to have a framework and a real sense of human discernment as to where on that spectrum is a particular business that you're evaluating. And this involves conversations about, often really gray seeming areas where multiple people are having to weigh in on us and say, like, what do we think? How do we feel about this particular situation? And so I don't want to say that this is easy. This is there are many times where we'll be looking at one another on a call or around a table, and it's what does your heart tell you? What does your gut tell you about this particular values concern? So there are those situations for sure, which can be difficult.
Well, gentlemen, I'm looking at the clock, and I wish we could just keep going with this conversation, but I'm also mindful of the fact that we have really plumbed the depths here with you, Jason. So, Adrian or Roshan, is there any last question that either of you has?
I'm all set, but it's been a great conversation, Jason. I really appreciate you joining us today.
Yeah, thank you very much, Jason.
My pleasure.
Yeah. Jason, truly a pleasure to have you, and who knows, where this will all lead for us and our listeners. But man, what a great introduction to this! We without your presence here could not have scratched the surface of what you've covered with us today.
Excellent.
Yeah, well, Jason, once again, I just want to say thank you again for joining us. For all of our listeners, this is Jason Myhre once again from Eventide. And we really enjoyed the conversation, and we'd love to maybe talk again in the future. And all of our listeners, thanks for joining us for another week. Please like, subscribe, give us 5 stars, tell your friends about us. This has been another episode of the Retirement Lifestyle Show, and we'll be back to help next week.
Bye.